The 2008 global financial crisis was a major economic downturn that had far-reaching effects on economies around the world. It marked the most severe financial crisis since the Great Depression of the 1930s, and is often attributed to a combination of factors in the financial sector, housing market, and regulatory environment. Here's an overview of the crisis, its causes, consequences, and responses. Causes of the crisis: housing bubble. In the early 2000s, the U.S. experienced a housing bubble characterized by rapidly rising home prices fueled by easy access to credit and low interest rates. Subprime mortgages, which were high-risk loans extended to borrowers with poor credit histories, became prevalent. These loans were often adjustable-rate mortgages, ARMs, with low initial payments that later increased sharply. Securitization and financial innovation. Financial institutions began bundling these subprime mortgages into complex financial products known as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. Rating agencies gave many of these securities high ratings, leading investors to believe they were low risk, which attracted significant investment. Deregulation and risk management failures. Deregulation in the financial industry, particularly the repeal of the Glass-Steagall Act in 1999, allowed commercial banks, investment banks, and insurance companies to merge and engage in riskier financial activities. Financial institutions underestimated the risks associated with mortgage-backed securities and failed to maintain adequate capital reserves. Excessive leverage. Many financial institutions used excessive leverage to boost returns on their investments. This meant they borrowed heavily to invest in high-risk assets, making them vulnerable to losses. When housing prices began to decline, the losses became unsustainable, leading to widespread defaults on subprime mortgages. The crisis unfolds. Collapse of major financial institutions. In 2007, the housing bubble began to burst, leading to rising mortgage defaults and falling home prices. By 2008, several major financial institutions faced insolvency. Notably, Lehman Brothers, a significant investment bank, filed for bankruptcy in September 2008, marking a pivotal moment in the crisis and triggering panic in global financial markets. Liquidity crisis. The collapse of Lehman Brothers and the failures of other financial institutions led to a severe liquidity crisis, as banks became unwilling to lend to each other due to fears of insolvency. Stock markets plummeted and consumer and business confidence eroded, leading to a contraction in economic activity. Global repercussions. The crisis quickly spread to economies worldwide due to interconnected financial systems. Global stock markets crashed, and many countries faced recessions. Governments and central banks in various countries had to respond to stabilize their economies and financial systems. Consequences of the crisis. Economic recession. The crisis led to a deep global recession, with significant contractions in economic output. Many countries experienced high unemployment rates, declining consumer spending, and a drop in business investment. In the U.S., the unemployment rate peaked at around 10% in October 2009, and GDP fell sharply.